What if you could get a real shortcut, a way to truly understand how a major consumer products company doesn't just, survive, but actually thrives when markets are turbulent and costs are soaring?
Right.
Today, we're not just skimming headlines, we're going deep, really dissecting the actual numbers and the strategic plays behind Marico Limited's performance.
Exactly. This is our deep dive into the Q1 FY26 financial results for Marico. They're a leading Indian consumer products player, as you
Yeah,
know.
yeah.
And our mission really is to pull out the most important nuggets, the key insights from all their official stuff, the financials, auditor reports, investor updates, and importantly, that recent earnings call.
We want to help you understand how they did it and what's really driving those results.
We spent time with the unaudited standalone and consolidated results for the quarter ending June 30th, 2025. Also, the review reports from BSR & Co., LLP, those detailed info updates, and yeah, the earnings call transcript too.
So whether you're just curious about market trends or maybe you're looking for those quick aha moments, or maybe you just find it interesting how these big consumer brands operate under pressure.
Then this should give you a really clear and hopefully engaging picture of Marico's journey through some pretty significant market shifts.
Okay, so let's jump right in. The big picture. Marico's overall performance for Q1 FY26. I mean, right off the bat, it looks like a multi-quarter high, doesn't it?
It really does. Consolidated revenue from operations hit 3,259 crore.
Which is roughly 3.26 billion Indian rupees.
Exactly. And that's a significant jump, 23% up year over year.
Wow.
And what's fascinating, like you said, it wasn't just a consolidated number. This high point extended to their India revenue growth and the underlying volume growth in the India business too. We haven't seen numbers like these for several quarters.
And that underlying volume growth in India.
Stood at a really strong 9%, very healthy.
Okay, and the international side. Didn't want to be left out, I guess.
Definitely not. It pulled its weight, delivering a robust 19% constant currency growth.
That kind of sync strength across both India and international, that's quite something.
It is. Now, looking at profit. Profit after tax, or PAT, came in at 504 crore. That's up 9% year over year.
Okay, still growing.
Yep. And EBITDA earnings for interest, taxes, depreciation, and amortization that increased by 5%, 655 crore. But, and this is important.
There's always a but.
Oh, well, yeah. You'll notice the EBITDA margin actually contracted, dropped about 360 basis points down to 20.1%.
Okay, that margin dip definitely stands out against that really strong top-line growth. What's the story there?
So the company pointed mainly to two things. First, sharp inflation in key commodities. Think copra, edible oils.
Right, those have been volatile.
Extremely. Second, they were up against a particularly high comparison base from the same quarter last year. And they also mentioned this pricing-led denominator effect.
Okay, break that down for us. Pricing-led denominator effect. Sounds a bit jargony.
It does, but it's actually fairly simple. Imagine your revenue shoots up, mainly because you had to raise prices to cover those higher input costs.
Okay.
So even if your total profit in rupees increased, maybe it didn't increase as fast as your revenue did. So when you calculate profit as a percentage of that much bigger revenue number, the margin can look smaller.
Got it. So the profit pie got bigger, but the whole cake got much, much bigger, making the slice look relatively smaller.
That's a good way to put it. And you see that reflected in the gross margin, too, which contracted by about 530 basis points year over year. Again, directly linked to that commodity inflation.
So a clear headwind there, even with impressive sales. Let's dive deeper into the India business then. That's the engine room, right? Revenues hit 2,495 crore, nearly 2.5 billion rupees. That's a really strong 27% year-over-year growth.
Yeah, huge. And it wasn't just a flash in the pan. They saw continued sequential improvement in underlying volume growth quarter on quarter.
That's a good sign.
And what really speaks volumes about their brand strength and, market position is their offtake growth. Get this. Roughly 99% of their business either gained or held on to its market share.
99%. Wow.
Yep. And over 80% gained or sustained penetration on an AM basis that's moving annual total. It shows deep consumer loyalty and really effective distribution reach.
That's incredible resilience. Okay, let's break down some key categories. Parachute, coconut oil, the flagship. It's what, 35% of their India revenues?
A huge chunk, yes.
It registered a 1% volume decline using traditional metrics, but you mentioned something interesting about pack sizes.
Right. This is fascinating.
Yeah.
When they normalized for what they call MLH changes, basically, adjusting for slight changes in pack size, like maybe shifting from a 100 milliliter bottle to a 90 milliliter one.
Okay.
The brand actually grew by 1% in terms of the number of packs sold.
So people are still buying Parachute, just maybe slightly smaller packs sometimes?
Exactly. And this resilience is frankly remarkable when you consider the copper price situation. Unprecedented hyperinflation. Copper was up 18% just from the previous quarter and a massive 107% compared to last year.
Ouch, 107%.
Yeah. And yet, Parachute has somehow absorbed cumulative price increases of over 60%, with minimal impact on the number of packs moving off the shelves.
That's not just pricing power, that's deep consumer trust.
Absolutely. It's brand stickiness built over decades.
Hmm.
Quality, distribution, trust. The management did mention, though, that copra prices have thankfully pulled back about 12% from their absolute peaks recently, so maybe some relief is coming.
Fingers crossed, that trust is a massive asset. Okay, moving on. Value-added hair oils, or VHS, that's about 20% of India revenue.
Correct. They grew 13% in value terms. That's a pretty decent step up in recovery, and it was driven mainly by the mid and premium segments within VHS.
So consumers may be trading up slightly within hair oils?
Seems like it. They also gained market share, about 140 basis points in value terms. Management sounds pretty optimistic about continued growth here. They're shifting strategy a bit,
How so?
moving away from just relying on, trade promotions and focusing more on actual brand building initiatives. Plus, they're boosting direct reach through this big project called Project SETI U, which we should probably talk more about.
Definitely.
And one other point on VHO, if you actually exclude one specific brand, Shanti Amla, the volume growth for the rest of the VHO portfolio was actually in double digits.
Interesting nuance. Okay, what about Saffola edible oils? 16% of India revenue. How did that category fare?
Saffola edible oils posted mid-single-digit volume growth. Revenue growth was much higher at 28%, likely due to pricing again.
Right.
What's notable here is how proactive they were. When import duties on vegetable oils were recently reduced, Saffola quickly passed that benefit on to consumers.
Building goodwill, perhaps?
Likely. Plus, they launched a new Saffola cold-pressed oils range, specifically targeting e-commerce and quick commerce platforms. So tapping into those modern trade channels effectively.
Makes sense. So beyond these core giants, Marico's clearly betting big on new growth areas too, right? Foods and premium personal care, especially the digital-first brands.
Absolutely. The foods portfolio, for instance, achieved around 20% value growth year on year. Solid performance.
And is that across the board in foods?
Pretty much.
Yeah.
Saffola Oats is still number one, gaining share. True Elements, the healthy breakfast brand they acquired, and Plix, the plant-based nutraceuticals one, both continued strong growth.
Winlix, right, that was another acquisition.
Yes. And even Saffola Muesli did well. They launched a couple new variants there, too. Mango Crunch and a no-added sugar berry crunch. Shows they're constantly innovating within the space.
And their ambitions for foods are, well, they're huge, aren't they?
Massive is the word. They're aiming for the foods portfolio to grow at a 25% plus compound annual growth rate, CAGR. The goal is to make it about 8 times its size back in FY20 by FY27.
8 times. That's transformational.
It really is. And crucially, they're not just chasing revenue. They've already managed to structurally expand the gross margin in foods by around 1,000 basis points over the last 2 fiscal years, FY24 and FY25.
Wow. Improving profitability while scaling that fast.
Yeah, and they expect more gradual improvements ahead. So, building a profitable foundation for that massive expansion plan.
Okay, switching gears slightly to the other growth engine, premium personal care, especially that digital-first portfolio.
Right. This area is really buzzing. It kept up its accelerated growth. We're talking brands like Beardo, Just Herbs, and the personal care side of Plix. Together, they exited the quarter at an annual run rate, or ARR, of over 850 crore.
850 million Indian rupees run rate. That's scaling fast.
Way ahead of their initial plans, actually.
Yeah.
Because of this strong performance, they've upped their target. Now they're aiming to scale this digital-first portfolio to about 2.5 times its FY24 ARR by FY27.
Ambitious. And what about profitability in these newer, often D2C brands?
Getting there. Beardo is expected to hit double-digit EBITDA margin this year. Plix is currently in single digits, but the overall goal for the entire portfolio is to reach double-digit EBITDA margin by FY27.
So a clear path to profitability.
Yes, and Marico positions itself cleverly here. They call themselves a strategic investor of choice for acquisitions in this digital space.
Meaning
Meaning they bring more than just cash to the table. They offer deep market knowledge, their huge distribution network, proven brand scaling expertise. It makes them a really attractive partner for up-and-coming digital brands looking to scale. synergies, shared knowledge, that kind of thing.
That makes a lot of sense. Okay, let's zoom out a bit now, beyond India. The global reach. International business seems to be firing on all cylinders, too.
Absolutely. It kept up that strong, double-digit, constant currency growth momentum. Delivered 19% constant currency growth, or CCG, this quarter. Very robust.
Where's that growth coming from, mainly? Any standout regions?
Well, Bangladesh put up a solid 17% CCG, showing good resilience. But the real star this quarter was Mirna, Middle East, and North Africa.
Oh, yeah.
An impressive 42% CCG. Really strong momentum, driven by growth in both Gulf countries and Egypt. It's clearly a region they're focusing on and investing in, and it's paying off.
42%, okay. What about other key markets?
South Africa was flattish in CCG terms this quarter, but management stressed that their full-year aspiration for double-digit growth there is still intact. They expect it to bounce back. Vietnam had a bit of a muted quarter, but again, they expect gradual recovery there. And their NCD and exports segment, that's non-core domestic stuff and exports, grew by a very healthy 37%.
It sounds like internationally they're also mirroring that premiumization strategy we saw in India, pushing higher value products.
Yes, exactly right. If you look at the revenue share from premium personal care categories, things like shampoos, skin care, hairstyling, baby care, and their international business,
Yeah.
it's increased quite a bit.
Yeah.
From around 20% back in FY21 to 29% in FY25. And they're targeting 25% plus growth in these premium segments internationally over the medium term. So a very deliberate strategic shift happening globally too.
Okay, so pulling all these threads together, the strong India core, the fast-growing new engines, the solid international performance, what does this tell us about their overall strategic vision and the outlook ahead?
Well, first, the context looks pretty supportive. The broader consumer sector anticipates a gradual pickup in demand. You've got easing inflation, a good monsoon season so far, continued government policy support.
Helpful tailwinds.
Definitely. Retail and food inflation were actually at multi-year lows back in June, and the monsoon is tracking above normal. These things generally help rural demand, which is important for companies like Marico.
And internally, they have this Project Set You initiative you mentioned earlier. Sounds significant.
It really is. Project Set You is a major transformative push to expand their direct reach within the general trade channel, like the millions of small Kirana stores across India.
Okay.
The goal is ambitious. Increase direct outlet reach from 1 million in FY24 to 1.5 million by FY27. It's a 3-year phased plan.
How are they doing it?
It involves a sharper focus on selling the right mix of products, improving the quality of service to retailers, and crucially, deploying AI-driven smart handheld devices, PDAs, for their sales force. This should make resource allocation much more efficient.
Using tech to optimize that last mile.
Precisely. Management says they're already seeing early positive signs and expect bigger results from the second half of the year onwards as it scales. It's a big bet on deepening their traditional distribution advantage.
That's a massive operational effort. Alongside that, the diversification strategy seems core to their plan.
Absolutely central. They're aggressively pushing the foods and premium personal care portfolios. The expectation is that these newer segments will contribute around 25% a quarter of India's total revenue by FY27.
So reducing reliance on just Parachute and VHO, essentially.
Exactly. Building resilience, capturing growth in faster-moving, potentially higher-margin areas. It's a classic diversification play, but they're executing it quite aggressively.
And looking further ahead, their long-term growth aspirations, they've set some pretty big targets.
They certainly have. They're sticking to their goal of double-digit revenue growth over the medium term. That's expected to come from, solid performance in the core India business, plus that accelerated growth in foods and premium personal care, and continued double-digit growth internationally.
And the specific turnover targets?
They're aiming for 15,000 crore, about 15 billion rupees in the next 2 years, and then 20,000 crore within the next 5 years.
Those are big leaps. Especially given the margin pressures we talked about earlier, how do they square that circle aggressive growth targets with potential short-term margin compression?
Yeah, that's the key question, isn't it? Look, they acknowledge that the operating margin percentage might look a bit squeezed in the near term because of that denominator effect from inflation-led price hikes.
Right.
But they expect the actual gross margin pressures from commodity costs to ease up from the second half of this fiscal year, FY26. And over the medium term, they project operating margins will actually start inching up, mainly due to operating leverage, getting more efficient as they get bigger, and that ongoing shift towards more premium products in their portfolio mix. They sound quite confident they can deliver double-digit profit CAGR over the next 2 years.
So the absolute profit growth story remains strong, even if the percentage fluctuates short term.
That seems to be the message. Profit growth is the focus.
And besides organic growth, they're also focused on costs and M&A.
Yes. They have an ongoing institutionalized cost management program they call Marvel to keep driving efficiencies. And yes, they're actively scouting for acquisitions, what they call inorganic growth opportunities.
To do what specifically?
Could be to consolidate their position in existing markets, maybe expand into adjacent categories, or even enter new countries. It's all part of strengthening their competitive position and driving long-term value. It shows they're thinking proactively, not just reacting.
Before we wrap up, it's probably worth touching on something else that came through in their reports, their focus on sustainability or ESG. It seems quite integrated.
It does, yeah. They highlighted quite a few points. Things like sourcing a high percentage, almost 80% of their energy from renewables.
Okay.
Significant reductions in water consumption intensity, rainwater harvesting, responsible sourcing with their suppliers. They have certifications and targets for their critical suppliers.
And initiatives beyond their factory gates.
Yes, things like their Parachute Kalpavriksha Foundation, which works with coconut farmers to improve productivity. They mentioned enrolling over 1.2 lakh farmers. Plus, social programs like the Niharshanti Pathshala Funwala for education, tree planting initiatives. It seems quite embedded.
And they've received some external recognition for this too, right?
They have mentioned awards for green practices, high ESG scores on the stock exchange platform, recognition for farmer livelihood programs, and consistent leadership awards for corporate governance. It paints a picture of a company looking beyond just the quarterly numbers.
Right, it adds another dimension to the story. So, wrapping this all up, you've just had a really comprehensive look at Marico Ltd's Q1 FY26. What really stands out to me isn't just the strong numbers, the revenue and volume growth, especially given those inflationary headwinds.
Yeah, the resilience is key.
It is, but it's also the clarity of their strategy. They're aggressively investing in these new growth areas, foods, digital-first brands. They're transforming their distribution backbone with Project Set 2. They're keeping that international momentum going strong. And, as we just discussed, they seem to be weaving sustainability pretty deeply into how they operate.
It feels like a company that's not just managing the present, but actively building its future, In a world that's constantly changing, seeing how a company like Marico juggles those immediate market pressures, the inflation, the competition with these really ambitious long-term diversification plans and ethical commitments, it's more than just looking at a financial statement.
It's kind of like seeing a blueprint for resilient growth, isn't it?
I think so. So maybe the final thought for you listening is this. What does Marico's really proactive approach to innovation, to market expansion, to fundamentally improving how they operate, what does that tell you about the future direction of the consumer goods industry? And maybe how could that influence your own thinking about what growth and adaptability really look like in such dynamic times?